Hey there, everybody. Derick Van Ness here with Big Life Financial, and I can't wait to share today's presentation with you on how to slash your taxes before the end of the year, and more importantly, how you can do this every single year into the future, because ultimately that's the goal, and we're going to talk about what that could really mean for you, because taxes are massively misunderstood, and I can't wait to share with you like exactly what's possible here. So the first thing is what you will learn today, right? Why are you here? What are you here to get? I want you to answer that for yourself real quick. What is it that you actually want? Let me tell you what you're going to get. You need to understand why you're overpaying taxes. Most of you, you know you are, you suspect you are, you don't really know why, you don't know what to do about it. That's why you're here. I want to make sure that you're getting exactly what you want out of this. The second thing is we're going to emphasize this mindset change, a blip in your head. It's like the sixth sense when the movie turns. That's going to happen for you with taxes today. And we're going to talk about what you need to do so you can keep more of the money you make. You're going to think about taxes completely differently by the time we're done today. And most importantly, I'm going to go over 7 specific strategies you can use to save 6 figures in your taxes starting today. You'll be able to do a bunch of these before the end of the year, but also into the future. This is going to be something you can do year after year. Okay. Now, the reason this is so important is whether you realize it or not, taxes are your number one expense, and they're robbing you blind, whether you realize it or not, right? It's just money going down the drain here. And nobody's helping you stop it. Most people think, well, isn't that what my CPA is for? Isn't that what my tax guy's for? You might think so. They would beg to differ. Here's what I mean. Most tax people that I'm aware of, what they end up doing is they are tax recorders, right? Their focus, and this is literally when people go and they study for the CPA test or they go through accounting school or whatever, they're not taught to save you taxes. What they're actually taught is to file on time and to be accurate. Those two things. And listen, I don't want to discount those things. They're very important. If your taxes aren't on time or they're not accurate, it's a big problem. But those are the baseline to me. That's like the floor, not the ceiling. The ceiling is how do we help you to pay the minimum amount of taxes legally and ethically every single year so you can keep more of the money you make? Because the reality is you're a business owner. You work your butt off. You take a ton of risk. You take on a ton of stress. You do so many things that the average person doesn't have to deal with. I want you to get rewarded for that. And that's what this is about, right? Is somebody being here to help you so that you can do this. And by the time we're done today, after I go through these 7 strategies, which are 7 of 100 you can use, we're going to go through some really cool stuff here. You're going to have a much better ability to pull the levers and control your tax bill in a very powerful way. So I want to run through a scenario here and just show you what's at stake, right? Let's say, and most of you who are here, you make a lot of money, right? So let's say that you could save this year, if you did things right, $100,000 in taxes, which is, we've done this for hundreds of clients. So I think it's very doable for you if you have a higher income. So what would this look like? $100,000 a year is great, but $100,000 over 10 years, over the next 10 years, is $1 million. Suddenly you go from, 100 grand's a big deal, but not that big a deal, to $1 million. And you're like, well, that's a lot over 10 years, right? Most of us would want an extra $1 million with zero extra work. Not very much, right? But that's only the tip of the iceberg. What if you took that $100,000 and you invested it, just put it to work somewhere where you could get 7%? And listen, there are places I'm aware of where you can get really close to 7% with like zero risk, right? So this is not some kind of thing, and we have a whole investing strategy and way we go about that. But like just if you did the basics, right? It becomes $1.3 million, 1.38 million. Not that big a deal, but I'll show you where the magic is. What if you did this for 20 years? Over 20 years, saving $100,000 a year now turns into $4.3 million in your bank account. And for a lot of us who are young enough to do this, over 30 years, just the tax savings, nothing else, no other investments and savings and tightening the belt. just not paying the taxes on things unnecessary to you over 30 years, that 100,000 a year turns into $9.4 million. That's what we're talking about. That is a huge amount of money. It's more than most people that I know will retire with just from tax savings alone, right? So if you're not playing the tax game, you aren't just losing money, you're losing freedom. When you don't have this money, you have to work harder, you have to work longer, you have more stress. You're not the best father, husband, wife, son, daughter, whatever that you need to be for the people around you. There's a huge cost to this. And the biggest thing is this: you're a business owner. You started a business because you probably want to have control of your own life. You want to call your own shots and you want to have freedom. Every time you give away money, you get rid of your freedom. Money creates time, and time is the ultimate freedom for all of us. So if you're feeling like I have to work too much, I can't do the things I want with my time, it's a time problem that's created by money, and you're losing it because you're not learning these things, right? So the real question is this: most people think, well, God, if I do tax strategy, is that risky? I could get audited. What if the IRS doesn't like something I do? Let me tell you the real risk: losing $100,000 or more every single year because you just don't want to play the game. Yes, can you get audited? For sure. But here's the reality. The IRS has come out and said if you earn over $400,000 a year, which are most people on this call, myself included, then you are not going to be able to hide under the radar. They have said we want to audit everybody who makes at least $400,000 a year at some point in their life. And here's why. You make more money, so you're probably doing more tax strategies. They just want to make sure you're doing it honestly. I'm a huge advocate of doing things honestly and ethically. And I'm also a huge advocate for you not overpaying and just bulldozing all of your money into a fireplace that the IRS gets, right? So the real risk is you losing your freedom, you not learning about this, and you giving up control of your own life because you don't have the money that you need to do that, not the risk of getting an audit. If you're worried about having an audit, there's plenty of things that can be done. And we're going to talk about how to document things and do them properly. But honestly, take the first 100 or $200,000 a year, sock it away. If you ever get audited and something's disallowed, use that money to pay the IRS and move on with your life. But in the meantime, you're building toward the freedom that you deserve and the life that you want, right? So I want you to get really clear. The risk of being audited is way less important than the risk of getting what you want financially in your life and being able to have the control so that you can call your own shots. So this is the mind shift. Most people see taxes as a necessary evil. Oh, I've got to deal with this. I've got to file. This sucks, right? This isn't about that. Taxes aren't a cost. They're not a necessary evil. They're a strategy game. And more importantly than that, they're an income game. I want you to make this shift in your brain of thinking of taxes as a new source of income. Every dollar you save in taxes is the same as a new dollar you make in your business. Here's the difference. A new dollar of profit, you have to get revenue, you've got employees, you've got equipment, you've got overhead, you've got costs, you've got risk, you've got marketing, you've got all those. And maybe you have to make 5 or 10 or $15 to keep one for you. With taxes, you don't have any of that. There's no new employees. There's no extra complexity. All you have to do is probably spend about an hour a month, and you can massively increase your bottom line because all that money that was going to the government, a bunch of it can now stay with you in a way that you can use to build the life that you want to live. So I want you to start thinking of taxes as an income stream. This is a make more money webinar, not a I've got to deal with taxes webinar. If you start thinking that way, taxes get really excited. It's like, oh, I spend an hour a month on this and I get to keep an extra 100 grand. I would take that side hustle. That's a pretty big deal. And the cool thing about taxes is they don't change that much year to year. So once you know the rules of the game, it's very easy. And it is a game. Once you understand how it goes, it's a lot simpler than you think. I know the tax code is 6,000 pages long. But the good news is when you've got a tax strategy team, we can give you the Cliff Notes version, help you understand the pieces that apply to you, and it's very easy to put in place, especially if you got someone helping you. right? So that's what's really important is that you get that this is an income game. It will change the way that you approach taxes. You'll go from doing the minimum and getting crushed on taxes to doing a whole lot more and keeping way more of your money. And it's really hard to overstate how much that's worth, right? Now, before we get into actual tax strategies, I don't know your situation. I'm not a CPA. Yes, I own part of a tax firm. Our team, who with licensed, credentialed people who know what they're doing, do file taxes. But the big thing is, I'm going to show you a bunch of strategies. Some of them will apply to you, some of them may not. You do need a tax professional to help you discern that. That's my making sure that you're not just going to go do something crazy thing, but it is important. What I am is a tax and wealth strategist, right? I help people to reduce taxes massively. I don't do tax returns. We have people that do that for us. I'm a business owner. I own multiple businesses, and I think of life as an adventure, and I want you to be able to do that too and live out the adventure that you want in your own life. Taxes is a first step in that because it helps you to keep so much more of the money that you're already making. So, why am I so passionate about this? I was not always a tax person. And if you would have told me in high school or college, you're going to grow up and teach tax strategy, I would have probably jumped off a bridge, right? Realistically, taxes seem like the most boring, most basic, most terrible thing you could ever talk about. But the reality was this. When I did start my first business, which was when I was 28 years old, I was a house flipper in Los Angeles. And I went from flipping 4 houses my first year to 12 my second year. By my third year, we were doing 24. And by the fourth year and beyond, we were doing between 25 and 35 houses a year. So I usually had 8, 10, 15 houses in the process of getting flipped. I was really good at that. I was really good at making money. What I did not understand was taxes and how to build wealth, right? And every single night when I went to sleep after I started making a lot of money, I always wonder how much of this is mine and how much of it's going to go to Uncle Sam and to keep all this money tied up. And it was in the back of my mind and I was worried about it and I didn't understand it and I didn't know how to fix it. And it was really frustrating. So what did I do? I figured I just need to make more money. But the more money I made, the more taxes I paid. You may have heard California is a fairly high tax state, so things just got worse, right? And that created a real frustration in me. Now, I'll be straight with you. I didn't do too much about it. I did learn a couple of strategies like cost segregation, which is a real estate specific strategy, and a few other things. I got the best CPA I could, but he honestly wasn't that proactive, and I paid a lot of taxes. Now, what I learned from all this was when the '08 crash happened, I got wiped out. I lost $2.5 million. I'd been in an accident and I couldn't oversee all my houses that were being flipped because I broke a femur. And I lost a lot of money, right? When that all went down, I realized I knew how to make money. I did not know how to grow it. I did not know how to protect it. I did not know how to tax optimize it, and I paid the price for it, right? So I know how frustrating it is. So when I reinvented myself post 2008, I learned how to become a financial professional. How does money work? How do taxes work? How do you keep more of the money you make? What do you do with it? How do you protect it? And how do you build multi-generational wealth? And I'm going to give you a couple pieces along the way as we go here, getting into this. But this is something near and dear to my heart because it used to cause me an awful lot of heartache when I was trying to figure this stuff out. So, a couple of statistics for you. Over 70% of small business owners believe they're paying taxes. What's the real number? When we do an internal audit, when we've looked at tax returns over the last couple of years, over 95% of business owners are massively overpaying taxes. So I'm not talking about 1,000 or two. I'm talking about 10, 20, 50, 100, 200,000 or more in taxes that people are overpaying. It's super common to see between 25 and $100,000 just like all day long, right? And I'm going to show you guys some really simple strategies that can easily save you $30,000 to $50,000 every single year. So we're going to get into that in just a minute. Here's the thing. As a small business owner, you're in a different situation. You need better advice than your W-2 employees, and you deserve it because you have so many more leverage you can pull, so many more moving parts, and so many more things you can do as a business owner that will allow you to keep more of the money you make. So this is for you. if you own a business and you're thinking, gosh, I'm tired of getting the same H&R Block, TurboTax, garbage tax advice, tax recorder who doesn't look forward at all, but always looks back and just tells me what I owe, this is your chance to break free of that. Okay. So let's get right into this. First strategy, how you pay yourself matters. A lot of you have this right, a bunch of you don't. I would say 50% of people that we look at do not get this right, and they're massively overpaying taxes. So it's important for you to understand there are different kinds of income. There's active income, there's passive income, there's distributions, there's W-2 or salary. They're all taxed differently, right? So you need to understand this part. And a lot of CPAs do a good job on this one. This is not one that's missed as often as some, but if you're not getting this right, it's costing you, right? So if you have an S corporation, there's something that you're allowed to do that you cannot do if you have a sole proprietorship or a partnership. And what that is you can take a different type of income from your business than you can if you have a sole proprietorship or a partnership. If you have an S corporation, you're actually able to take some of your income as what I call business owner income. It's distributions or dividends or owner's draw. That is taxed at a lower tax rate than your W-2, which is just your full blast, pay all the taxes, active income, and everything you do as a sole proprietor or partnership is going to be taxed full blast that way. So what does that look like, right? As an active W-2 employee or active W-2 income, and you should all be paying yourself some of it as a W-2 because you are an employee of your business. And so the part of your business that you should be paying yourself for as a W-2, you got to pay. The rest, ideally, you want to take as business owner income. So there's two ways you can think about this. One is, what would I have to pay an employee to do my job, right? If you could replace yourself for 50, 75, 100, $200,000, that's probably what you should pay yourself with the W-2 active income, and then pay yourself the rest as distribution income, right? Um, this portion will be taxed differently. So let me show you the difference. If we have the scenario, the income type, payroll taxes, total tax paid, and the savings, if you don't have an S corporation, so if you're a sole proprietor or a partnership, if you had a $500,000 income, you would take all of it as salary or W-2. You pay payroll taxes on all of it, which is about 15.3%. And some of that does phase out. You're going to pay about $37,000, right? In contrast to that, if you took a couple hundred as salary and the rest as distributions, you're only going to pay payroll taxes on the salary part. The half of the payroll taxes you're going to save about 7.3%. You're only going to pay 21,000 instead of 37,000. That's going to save you almost $16,000, just that one move alone of taking your income differently. To you, it doesn't feel any different. The money still ends up in your bank account, but the way that it taxed is different, so it matters. And there's a bunch of other nuances and tricks you can do here, but I want you to get the concept right. Step number 2, the Augusta rule. A lot of people have heard about this. This is the home rental rule, which is different than having a home office, right? This is my home office. This is different than the Augusta rule. The Augusta rule is being able to rent out your home up to 14 days a year, tax-free, right? So you could put your house on Airbnb or VRBO and rent it out. And if you do that, the first 14 days that it's rented out, you can keep that income tax-free. But here's the thing. You probably don't want to rent out your house to strangers. I don't blame you. There's a better way to do it for you as a business owner. As a business owner, you're often going and you're renting out spaces, hotel rooms, back office or office spaces, places where, like at the back at the steakhouse or whatever, where it's a room where you can meet with your team. Basically, if we're looking at how to use the Augusta rule, anytime you're doing company planning and retreats and going to go off site, you're going to do holiday parties, you're going to do team building. Basically, anything where you normally rent space at an event center, conference room, or whatever, you can do those at your house instead. When you do them at your house, then you're able to pay yourself from the business to you personally, and all that income comes into your household tax-free, right? So this is a really nice win, especially if you're already doing quarterly trainings, if you're doing team retreats, if you're doing team building, if you're doing holiday parties and celebrations, all of this stuff can be done at your house. Now you want to document this, okay? So a couple key documents. One is you want to have a lease between you and your business. Obviously, it doesn't need to be airtight. You're both of those, but you can put down the dates, the rate, what's happening and why it's being rented. The second thing I would have is some proof of business purpose, right? Have an agenda, have notes taken if it's like, especially if it's corporate team meetings. If you want, take pictures of you and your team working in the space. So if someone ever came and said, hey, we want to know, is this legit? You can show them. Do not make this stuff up. Honestly, I spend a lot of time in California. I live in Utah. But I spend a couple months of the year in California, so I'm not able to always get all of my 14 days into the Augusta rule. I don't fake it. I do what I say I do. And I encourage you to do the same. But this is something where if you're already spending the money, you may as well pay it to yourself. You may as well use your home and you may as well get that money tax free because I know most of you are at a higher tax rate. So it really does add up. And we'll do some quick math in a minute here. Number three. Now, I know a lot of you are aware that you can pay your kids. I get a lot of questions about how to do this. And you can talk to your tax person about how to do it. Like, do you put them on payroll? Do you write them a check? Where does the money go? All of that sort of thing. I want to dig a little deeper and I want to show you not just how to do this, but I want to show you the advanced version that puts this thing on steroids and can make this super powerful, not only tax-wise, but in building your legacy. So let me show you what I'm talking about. Okay. First thing to know, you can pay your kids $14,600 this year, tax-free. Um, every single year, the number changes just a little bit, but it's good to know there's a number every year you can pay your kids for work, for real work that they're doing in your business every single year. And that's great tax efficiency because you would pay 40 cents on the dollar. Your kids are going to pay zero on this, right? Maybe a little bit of payroll tax at most. So the question comes up a lot. How can my kids work in the business? I'm going to just shotgun through a bunch of things that kids can do. Obviously, when kids are very, very young, there's limitations to that, right? But one of the things you can do with very young children is you can create an NIL contract, name, image, and likeness contract. You could do this because it's going to be between you and you. You could probably just do it through AI or download some forms online. If you want to be really efficient about it, you can get it done with a professional attorney. But at the end of the day, you can use your kids in your social media, use them on the website as part of your family brand, part of what you are, if that's appropriate for what you do, and you can pay your kids for that. But beyond that, once the kids get a little bit older, let me show you a bunch of the things that kids can do. And then I'll come back to what I was just showing there. So kids can help with social media and marketing. They're able to make posts, they're able to do things with AI these days. Once your kids are about 12, 13, 14, like they can do some pretty incredible stuff. And it's probably only going to get better. They can do administrative tasks. This is everything from answering the phones to filing, all kinds of things. They can help with customer service. They can do content creation and documentation. Kids are probably better at this, young people are, than people of my generation, right? They're great with tech. They can do tech and software support. They can train your team. They can help get things set up. They're really good at these. These are all high skill things, right? Uh, Within the family business, I like to pay the kids to help with building what I call the family enterprise, right? So what is the family enterprise? This is where you can build some legacy. The family enterprise is an entity that you create. This is your primary business over here. This is a separate business you have for family assets. So money comes out of the business, goes here, out of this family enterprise account. In most cases, it's going to be an LLC. You can pay yourself your living expenses and your emergency fund, but you can also hire the kids here. What do the kids help the family enterprise to do? They can help with taxes and tax strategy. They can do their own taxes. They can do your taxes. They can help with investments and growth. If you have rental properties, if you own the building that your business is in, they can help with reviewing that, make sure it's good. They can do their own budgeting on the things that they have for their own expenses because that's part of what the family is paying for, right? We teach people how to do a family banking system. Once they learn that, they could do it. But really, the family enterprise account is where you manage all your investments, all your money, all your businesses, and the kids can help with all of this. Now, when they're younger, they're not going to be doing as much, but as they get older, they can really do valuable things. When I was in high school, I was doing payroll for my dad's business. I was helping him to run job bids with spreadsheets and, putting in man hours and labor costs and material costs and all kinds of things. Did I screw a bunch of it up? Yeah, I screwed it up. Did I learn from it? Yes, I did. And it's probably not a coincidence I do what I do for a living. I mean, my dad literally taught me the rule of 72, which is a rule of how to figure out in your head how fast your money will double based on the rate of return you get. I think I learned it in fifth grade when I had the chicken pox, right? Like, this is an opportunity for you to teach your kids with real world stuff about money. Don't make it a taboo thing because you're going to leave this to them. At some point, they're going to inherit either your business or your estate or whatever you leave behind to them. If it's going to be a lot of money, I guarantee you that if they are unprepared because they haven't been exposed to this, it's going to be a curse, not a gift. Prepare your kids so that when this comes down and rolls down to them, this is a gift and they can use it to have an even bigger impact in the world. And that's what the family enterprise account is about, is building legacy, but also tax efficiency by paying your kids to do all the things that you probably wanted to teach them and have them do anyway. Think of them as junior executives in your business because at some point they are going to be running the show, right? So we went past these things in the family assets and wealth part of the business. They can do investment tracking and reporting. So they can look at your stock market portfolio, your real estate portfolio. They can do budget and expense tracking, especially if you've got businesses or side hustles. They can help with real estate or asset management. They can do family financial meetings. If you're going to do monthly meetings or quarterly meetings with your family to review this stuff, have the kids plan it, have them put together the agenda, have them come up and do some research and prepare for that, right? And then charitable giving and philanthropy. And I love this one. When I've watched and read about some of the what the Rockefellers have done to keep the family together and keep the family wealth together, they did not build businesses together so much. What they did was charitable giving and philanthropy together. The family would come together, organize, put together resources, work together. They got to know each other. They got to work together on impacting the world and building bigger things bigger than themselves. So it wasn't about fights about money and all of that. Charitable giving and philanthropy is a great way to have your family grow and learn together and be able to pay them effectively to do these things. So when you do all this, best practices are, have them on payroll, formalize the compensation, have an educational component in what you're teaching them so that they're learning the things you want them to learn. Mentor them just like a junior executive. And just like you would with any other employee, set clear expectations and outcomes so that you can really get the most out of them. But that's going to set you up to make sure you're doing these things in a structured way. So uh, let's get into the advanced stuff here. Listen, paying your kids $14,600 a year, tax free, it's great. It's awesome. It's going to save you some money. It's going to give more money to the household. But the kids are in a much lower tax bracket than you, even beyond the 14,600. You can use this to help them pay for school, learn about money and develop skills, and pay for their own costs in a tax efficient way. So let me give you a really important example here. Okay. If you wanted to help your kid with college costs, let's use this example. And you've got an 18-year-old, they're starting college, and let's say annual tuition and living expenses is going to cost them 30 grand. So you want to help them pay, but how you pay them makes a big difference. So let's look at this first scenario. Option number one here. You pay your kids $30,000 of tuition and expenses out of your own pocket. So if you do that, you have to earn the income, you have to pay the taxes, and then whatever's left, you've got to give your kids to go to college. So if you do it this way, if you want to give them 30, you have to earn 50. If you're in a 40% tax bracket, pay 20% of that in taxes so that you can give your kid 30, right? So you got to earn 50 to give them 30. That's incredibly expensive, right? Like that college is expensive enough on its own. If you got to pay Uncle Sam full blast for that before you give it to your kids, it almost doubles the cost. It is a huge expense, right? So let's look at option number two here. Let's say you decide to go about this by hiring your child and letting them pay for their own education. And the goal is that they end up with $30,000 after the taxes are paid. You can actually, and I backed into this number, but you can actually pay your child $31,710 in wages. The first $14,600 is tax-free. The remaining $17,000 is at 10%. So your child, you pay them $31,710, they end up at $30,000, right? So this is a huge difference for you in how much money it takes to help your kids fund their education. The difference between the two here is $18,690 per year, right? This is per year per kid. So rather than paying 50 or making 50, you only have to give them 31. So you make 31 and pay them for legitimate work so that they can keep 30 and pay for their own schooling. And if we look at the cost savings over here, right? Tax cost by doing it yourself is 20 grand. By paying your child is about 1,700. If we do the math on that, that's 18,000 a year. But on a 4-year degree, that's $73,000 just in tax efficiency per child. And if they go for 5 years, which isn't uncommon, it's more than that. But if you got 3 kids, we're talking about a couple $100,000, almost $250,000 here in tax savings just by doing this efficiency. And here's the best part. You're teaching your kids about money along the way, right? Most entrepreneurs I know want to do that. This is a great way to do it. So, strategy number 4, less glamorous, but I use this one to make a point, the home office strategy. People ask me all the time, is having a home office, is it a red flag? The reality is, if you actually have a home office and you use it for business exclusively or pretty exclusively, then yes, you can write that off and it's not a red flag. I've got a news flash. Your laptop in your bedroom, not a home office, right? That is a bedroom with a laptop. What I'm in right here, this is a home office. I have this big, beautiful room. I use it exclusively for business. Got filing cabinets. I've got books. I've got the whole setup with the lighting and everything else. This is an office. I can deduct this legally and not have to worry about it. I promise you, it is not worth it to make up stuff with your taxes. Don't make up stuff like a home office. Making stuff up, yes, it's a red flag because you're lying. Don't lie to the IRS. Do things that comply with their code in the way that they want, and you get to write them off. If not, don't write them off. It's not worth it. Okay. But yes, you can write off a home office. It's not going to change the world, but it can help a little bit, right? So let's do a quick pulse check. What have we gone over so far, and what might this be worth to you? So the first thing is, if you take some of your money as an owner's draw instead of all of it as salary, and let's say you took 200,000 passive, like we talked about earlier, that'd save you around $15,000 a year. Second thing, if you did the Augusta rule, rented out your home for $1,250 a day, 14 days, depending on your tax bracket, this would save you between $5,250 and almost $8,000. If you were paying your kids, and this is not going crazy with the advanced stuff like I was talking about, where you could be saving 20,000 bucks per kid per year. This is if you pay your kids between $10,000 and $15,000 each, and you got 3 kids, that can save you between $9,000 and $20,000 a year. Ton of money. And then if you did a home office, right, and you're paying deducting 500 bucks a month, that might save you between 1,800 and 2,600, once again, depending on your tax bracket. So if we put all this stuff together, we're talking about $31,000 to $46,000 per year that you get to do every single year from here forward, right? We showed that 100,000 a year, what that can turn into. This is another example of how you get there with a bunch of smaller strategies. The stuff I'm going to show you coming up is even bigger, except for the kid one can be quite large. I mean, you can literally save a lot of money helping your kids pay for college and save and do good work for your business. It's massively tax efficient, and it's great for building legacy. So I love this quote, and I hear this all the time from business owners who say, I asked my CPA, like, my income's up. How do I pay less taxes? And they say, hey, it's just part of making more money. Just get used to paying more taxes. It doesn't have to be that way. And I think you're starting to see that here. So let's get into some more advanced things. Strategy number 5. I see a decent amount of people doing this, but I also see a ton of CPAs miss it. This is something that happened not in the big beautiful bill, but prior to that with the last tax rewrite, is using something called the pass-through entity. So what is the pass-through entity? It's a way to make your state deductions or state taxes a federal deduction. Okay. So what you do is you pay your state taxes before the end of the year. You file for the pass-through. This is something your CPA has to do, and then you get to keep more of the money. So let's do a scenario. Let's say you're in a state with 5% tax, right? If you're in New York or Oregon or California, it's a lot more than this. Let's say you make 500,000, state tax is 5%. So you pay $25,000 in state tax before the end of the year. I realize you're paying your state taxes with your W-2 throughout the year, but you're going to owe some more at the end of the year, and you need to settle up with the state. Don't wait until April 15th to pay that. If you pay it before December 31st, now it becomes a business deduction, and that flows through to you, and you have a lower tax rate or lower federal tax that you pay, right? So you pay 25,000 in state taxes, that creates a $25,000 federal tax deduction. If you're in a 40% tax bracket, that's going to save you $10,000 just doing that one simple thing, right? $10,000 just paid for that. Like I said, we see this miss all the time when we do tax reviews. So, and most people don't even realize that they're like, yeah, I'm paying my state taxes, but they're not paying all of the state taxes. They're just paying a portion, the W-2 portion all year. They're not doing the other part. So don't miss this one. It's an easy $5, $10, $15,000 for you. Number 6. Now I'm going to go through these with you at a high level. Each one of these has the ability to save you 6 figures a year all by itself. And each one of these could be its own webinar. So I'm not going to go too deep into them, but I want you to know they're out there. If you're an accredited investor and you're a high income earner, you probably qualify for tax smart investments. These are investments that when you put money into an investment, you get a big tax break. The government incentivizes certain things because they want you to put money into them so that it builds infrastructure, or like there's a bunch of tax breaks around energy. So it could be solar, it could be oil, it could be natural gas, could be a bunch of other things. There's a bunch of other different types of investments out there that have tax breaks on them. But ultimately, if you can put in $1 and get a write-off of anywhere from 90 cents to 100 or $1.10, and you're actually just writing off all of that money that you invested, that's going to be a huge tax break for you. So if you're going to invest the money anyway, this could be a huge way to save taxes while you're doing that, right? You need to look at the specifics, make sure it's the right thing for you. But there's a ton of these. This stuff is black and white, right in the tax code. Just most people aren't aware of it. And most CPAs and tax people, they're not investment people, so they don't see these, right? So we work with an investment group that's one of our sister companies that does a lot of this stuff. Could be that your people have it. Talk to a professional about it. But these are huge. You can save 6 figures just on that. Leverage donations. This is a whole group of strategies where essentially what you're doing is you're investing $1 into something at wholesale. And then normally that investment will go out and be sold at retail and you'd make the money. In this case, rather than selling it at retail, it gets donated at retail. And so you get a tax break or a write-off. And in a lot of cases, for every dollar you put in, you might get a 3, 4, 5, 6,000 or 3, 4, 5, or $6 write-off. So you put in one, it creates leverage to get you more than $1 of a write-off. In many cases, this can massively reduce taxes, depending on your income bracket, but especially if you're over 400,000, the strategy can be super, super powerful. And then entity and legacy, like estate planning structuring, there's so much that can be done here. And the more money you make, the bigger this gets. But if you have things like dynasty trusts, if you have holding companies, if you're moving money from one company to another, you can create a lot of tax efficiency by doing the right things for your business anyway. But it can also, like we talked about with how you pay yourself matters. We can shift income and put it in places where it's all legitimate expenses and everything, but you can really create a ton of tax efficiency. And like once you get into seven figures plus of earning, this can just like skyrocket how much you can save in taxes. So any one of these three can save you six figures or more per year, depending on your income. Uh, like I said, there's just so much here that we can't even get into that. We've done webinars on webinars about each of these things. So don't want to spend too much time on it today, but I want you to know they exist. And if you want to get some help, I'm going to show you how to do that at the end of the call today. So I want you to think about taxes as a system because you do not rise to the level of your goals. Your goal might be to pay less tax. You actually fall to the level of your systems. So if you don't have good systems, you're not going to rise up and get the goal, right? Everybody who's on here has the goal of paying less taxes, but that doesn't mean more or less of you will get that because you have the goal. It's the systems you put in place that methodically take care of taxes along the way. Tax isn't a December thing. It's not even a November and December thing. Tax is a year-round thing. Doesn't mean you need to be obsessed with it, but your business as it's happening throughout the year, there are opportunities to reduce taxes and take care of it. If you do this, and like I said, in an hour a month, you can plan better than most tax preparers. I did a whole webinar on that as well, just on how you can prepare and think about this differently. But I want you to think about taxes as an income stream and a system that will totally change the way you approach it. And when you use these kinds of things effectively, these tax advantaged investments and a lot of the other stuff I talked about, in a lot of cases, you can cut your taxes by 50% or more. Like if you're on the lower end and you're doing all the strategies I showed in the beginning, you might just wipe out your whole tax bill. The more money you make, the more we can save you, but also there comes a point where you just got to pay some taxes, right? But we can dramatically reduce those. And I want to wrap up here with the biggest no-brainer strategy that you can implement right now. And we've done this for thousands of clients, and it makes a huge difference. And it's called the research and development tax credits. Now, I haven't been talking about this the past couple of years because in 2022, basically the IRS tax code broke the R&D credits. But with a new tax bill in 2025, it brought these credits back and made them worth doing again. And so I won't go into the details here of how it broke. You can look it up if you want, but essentially it just wasn't worth doing the credits. But since they fixed it, the government's giving us until July 4th of 2026 to go back and claim tax years 22, 23, and 24. Now, if you're seeing this later on a replay or something, and it's past July 6th of 20, I'm sorry, July 4th of 2026, that's okay. You can do these tax credits into perpetuity. You can do them every single year. They're just giving us a year to go back and file these tax returns in the past because they were broken. And so this is a huge opportunity to get 3 years worth of tax credits back all in one time. And you've got, until July 4th of 26 to do that. But the R&D credits themselves have been around since 1981. They were designed to help the automotive industry. And really, the government wants to sponsor these credits to get people to try new stuff, right? These have been around forever. This is not the same as the 2020 credits. That's a whole different thing. These tax credits have been around. They're a permanent part of the tax code, Section 41. And how they work is this. Every dollar you spend in your business that checks these four boxes can help to start create credits for you. The first one is, are you improving a product or process? Right? Are you trying to make things better, faster, more efficient? Are you reducing technological uncertainty? This means when you do something, when you do a diagnostic, when you do a procedure, when you put together a plan for something, does that end up happening? Are you trying to make things more consistent? Is there a process of experimentation? Is this new for your business? Do you have to test it? Do you have to modify or evaluate alternatives? Do you have to prototype or simulate it? Anything you're doing, anything you're doing that's new in your business is more than likely checking this box. If you buy new equipment, and it's not the same, it's an upgrade and has new features that may or may not work as well, that's going to probably help qualify. And the last thing is it technological in nature? Specifically, are you using engineering, computer science, biology, or physical science? So to make that really simple, if you're doing new stuff in your business and is based in science, and you're trying to get better, it's probably checking those boxes. And a huge part of it, because we work with so many service type businesses, is the labor you're paying your employees. You don't necessarily, if you get a new piece of equipment, you already get to depreciate the equipment. So that doesn't create credits, but what does create credits is all the time your team's going to put in to determine, hey, we've got a problem we need to solve. What are the solutions that are out there? Oh, we like this machine or this approach, this equipment. Let's get that. Then we have to test it and figure out, does this work with our workflow? Is this better? Are we getting more consistent outcomes? And you got to tweak it and you got to test it and you got to figure it out. All those hours that go into that are likely creating credits for you so that you can get some of the money back, because the IRS knows when you try new stuff, sometimes it doesn't work. They don't want you to stop, so they're giving you a little bit of an incentive to do that. So when you do this new stuff, there's something called qualified research activities, which is your people doing the stuff that qualifies, and then the expenses. How much are you paying them for it? Or what is the cost of the materials involved? Those are what create the credits. So let me give you a simple example. Let's say you have $400,000 of payroll, and we determine when we look at it that 50% of the people in your business and their time is qualified research activities. So that means there's 200,000 qualifying dollars, and there's a multiple here. This does change a little bit depending on your business and stuff, but you get, of that 200,000, you get 5 to 8, you might get 5 to 8% back. So that's either 10 up to $16,000 per year that you could get back in credits. Now, if we're able to look at this, if you did 22, 23, and 24, you can get back 3 years worth. So that might be worth between $30,000 and $48,000 in credit refunds for you. And let's be super clear, credits are not a write-off. These are dollar for dollar. If you get 30,000 of credits, that's $30,000 you get to keep, or $30,000 in checks the IRS will send back to you. And they'll even pay you interest on the stuff. So it's great. But it's very simple. The process probably takes you a total of maybe 2 hours. Usually you want to do an introductory call, make sure that you're a good candidate. If so, then you need to work with someone. Our team does a projects call. You don't have to work with our team, but we make it super easy. We quickly walk you through, ask you all the things that you've done. We know how to document it in the way that the IRS wants to see it. We'll give you a free estimate for how much money you can get back before you have to decide if you want to do it or not. If you do, you engage our team, and a week or two later, you will have you'll have the credit study. And your CPA doesn't need to be involved if they don't want to do the amendment. Our team can do it. For 2025 and forward, if you're doing these proactively, you don't even need to do an amendment. You just use the credit study and you just don't pay the taxes. It's awesome. You just pay a small fee for our team to do the work. But if you need to file backwards, they're going to send you a check, and the IRS will process those checks and get the money to you, right? So in total for you, it's probably 2 hours. It's very easy. And an hour of that is just doing the projects, and the rest is just gathering your tax returns. So if you're organized, probably less than that. Let me give you some quick examples. We work with a lot of dentists in the dental industry that we've done just recently. We had one that was a clinic, and doctors are very similar to this. And we work with a lot of auto repair shops and construction companies. They get these kind of refunds too. This is a doctor in Minnesota, got $47,000 over 3 years. It was a smaller clinic, so they were getting about $15,000 a year. Second one, these guys had two clinics. This was in the Midwest. They got $150,000, so about $50,000 a year, just for stuff they were already doing inside of their business. They just needed to claim the credits. And the third one was a business up in New York. They had two locations. They got $225,000 of R&D credits over 3 years, but it was a huge shot in the arm for them that they didn't even know that they could get back. So we're talking about some serious money here that could be coming back to you very, very easily. And for 2 hours of time, 225 grand, that's a pretty good hourly rate where I come from. And this really adds up when you put it all together. All of the different credits that we just talked about, but also the tax advantaged investments and the donations and all of that. And then all of the paying your kids and all of the how you pay yourself and getting the pass-through entity. This stuff really adds up. And all of a sudden, that $100,000 a year in tax savings doesn't feel so big or unrealistic, right? Just with these seven things, and there's about 20 other things you could do as well, depending on your situation. Let's remember that's $9.4 million without you having to cut your expenses, budget, spend less money, anything. This is pure tax savings coming straight out of the money that you would have sent Uncle Sam, but now that you know the difference, you can keep it. So, coming back to this question, what's riskier? Paying too much or learning to pay less, right? If you pay too much, that's going to be a massive cost on you. The cost of ignorance in this case is over $9 million. The risk of learning, yeah, you got to put in a little bit, maybe an hour a month, right? It's a very small cost, and I think it's a no-brainer. So, what would an extra $100,000 or an extra $9.4 million in retirement do for you? Right? You really have two choices. You can just keep doing things the way that you have been and getting the same results that you have been. And listen, Uncle Sam will love you for it. That's great. But the reality is, you have the other choice, and that is to figure out where you have been overpaying. Maybe everything I talked about doesn't apply to you, but there's a bunch of things that do. We do enough of these tax reviews, which is what we're offering here, a 3-year tax review, that I can tell you 95% or more of the businesses we look at are dramatically overpaying taxes. I'm not talking 1,000 or two, I'm talking significant amounts of money, right? And you also get a bonus R&D credits estimate for free. All you got to do is just scan the code here. Or for some reason you're on your phone and scanning the code is hard. You can go to biglifefinancial.com/taxes/webinar. You can see the link down at the bottom here, or just go to the Big Life Financial website, click the button up in the corner that says work with us. You can schedule an appointment there. We'll get it set up for you. But ultimately, I know this, okay? You're a small business owner. You spend a ton of time and money getting this stuff right and making the money in the first place. You take a ton of risk. You stay up late at night. You deal with all the stress and all the headaches and all the responsibility. I want you to keep a lot more of the money that you make. You deserve it. And it's not that hard if you get some good help. If you've never seen what this looks like before, or you're on the fence, just set up a call. Come see what's possible. I guarantee it's going to be easier than you think, and you might be shocked at how much you're overpaying. You've seen what's at stake here. Don't pass this by. Don't let that huge number freak you out. Let's say you only save 50 grand a year. It's still 50 grand a year. It's proportional. People who make more save more. People who make less might save a little bit less, but to you, it's going to be a meaningful number, and I want to make sure you miss out, that you don't miss out. So I appreciate you taking some time to be here. If you have questions or if you need things, let us know. Otherwise, I'm going to let you go here and hope to see you on my calendar or working with my team sometime soon. Thanks.